everyone, it is Evan here from the Trade Risk on Friday, August 4th, 2023. I am on the road today, backup computer, shoddy internet connection. We're going to see if we can make this work. The show must go on. It's going to be brief. We're going to probably skip a couple of our usual data points here, but I wanted to at least get a touch point this week. It was a pretty influential sort of transition week, a little bit of a pivot here in markets. So let's get into it right here with our index performance. If you follow my mouse up here, you can see that we were down pretty much the biggest week down for US equity indices since approximately March of this year. So it was one of the tougher weeks. We've been on a nice run to the upside here, so a little bit of a pullback, pivot, turnaround. S&P down 2.25%, Nasdaq was down 3%, Dow Jones, Russell both down about 1%. Notice the volatility indexes here, though. So we're looking at the Nasdaq vol and the S&P, and you can see that the VIX is up to 17.25. That was 13.33 last week, so up almost 4 points. That's a big move for the VIX. We're still sub 20, so in my book, you know, we're in maybe the still the optimistic or the potential uptrending mode for volatility, but this is certainly a transition week here with a good spike in volatility. Nasdaq vol over 20. You can see here on these line charts, basically stock markets starting the week in the top left, finishing in the bottom right. A good old-fashioned sell week. Now, if we go to our sector performance here, right-hand side, everything was in the red except for energy. Energy was up 1% on the week, followed by consumer discretionary and financials, which those two were both down almost 1%. Everything else negative. Utilities, the hardest hit this week because we had a big surge in interest rates across maturities here. That's one of the big stories from this week. We had basically a breakout in yields. We had a credit rating downgrade. So there were lots of kind of interesting dynamics at play. But utilities at the bottom of the list here, lagging 4.5% lower. Tech also down almost 4%. And communication services 2.5% lower. If we take a look here at our smart trend filter. So this is a custom indicator here we designed for TC2000 users. It's also available for TradingView. You can check it out on our website. But it really just sort of objectively measures trend using price and volume spanning across time. And you can see here on the daily charts, we're getting our first sell signal in tech for in the XLK ETF here since we had a little bit of a transition down here back in April of this year. So we've been in this nice kind of clear sailing uptrend for technology. You can see earlier in the week we transitioned to neutral, which is this yellow reading, and then we rolled over and confirmed a sell signal here for technology. Big trends, weekly charts still, you know, looking better, but in the short term, and I'm using short term as a daily chart, we finally got that sell signal here, and you're seeing a lot of other yellow transition periods here. Same thing for communication services, consumer discretionary, real estate, all sort of either turning neutral to down, and same thing with financials, industrials, neutral, materials, utilities rolled over, bearish signal. And I think that is it. The only thing, frankly, that is still in a confirmed bullish uptrend here is energy now, with that using our smart trend filter. So very interesting there in terms of dynamics underneath the hood of sectors. If we take a look at market breadth here, so if you follow my mouse down in the bottom left, this is the 52-week highs and lows that we track each and every video update that we do. And you can see for the last 3 days, we've got more stocks making 52-week lows than we do making 52-week highs. That ratio is starting to go in the other direction. Now, we're not seeing a big expansion in 52-week lows just yet, but it's something we want to keep an eye out on. This pullback is so far what I would consider relatively innocent in terms of its magnitude, scope, and damage for markets, but if this continues, if we continue to see more weakness here, we're going to want to keep a very close pulse on breath here regarding 52-week lows. You can see our gauges here all pretty much negative in terms of rank percentile of stocks that are down on the week. You can also see that the percentage of stocks in the 50 above a 50 SMA in the NYSE certainly took a little bit of a hit this week, down from about 74% all the way down to 62%, a sub 60%, frankly, back here on Thursday. So a little bit of, again, just that pressure across the board. Now, if we take a look at IBD's top, IBD's 50, we're looking at the top 10 here. There were some changes to their IBD 50 list, or the top 10 list this week. IoT, FC, NCA, EME, all sort of making the list now in the 8, 9, and 10 spot. IBD is a sponsor of the show. You can find links to access their digital subscription here. So shout out to IBD. Thanks for making the show possible. You can support the show signing up with a link in the description. Pretty cheap monthly service for all of the lists and content that they provide in their digital subscription. But if we look here on the week for IBD's list here, you can see also a good amount of selling pressure, some high single digits selling off here in Carnival, Royal Caribbean, DraftKings was pretty resilient. This ACLS was down almost 9%, Samsara down 7%, but a couple of stocks managed to finish green here. So nice kind of leadership curation going on there in IBD land. If we take a look at commodities here, you can see oil did manage to buck the trend this week. It was up 2.4%, hence the positive performance out of a lot of that energy sector that we looked at just a moment ago. We did see the dollar index up almost 0.5%, pretty good move there for dollar index, which is continuing its rebound. Gold, agriculture, natural gas, silver, all down about 2% this week. And you can see in commodities here, minus X oil, basically, USO, you're starting to see a lot of these trends move to a sell signal or flat out neutral this week or earlier in the week. Now, the big story this week was Treasury yields. Everything was up sharply, including the MOVE index, which is basically the VIX for the fixed income markets. You can see that yields were up, and this is what's starting to put a lot of pressure on stocks now, is when we're getting this ratchet up in interest rates, when they move vertical, this always tends to pose a problem. This is one of the risk factors we've been talking about to this equity market rally, is if we do get some yields breaking out here, that could cause some problems. And when we look here at just these technical patterns, you can see that interest rates have really been in this holding pattern for almost a year now. And, if we are turning into one big continuation pattern here in lots of these markets where they've just treaded sideways for, 6, 7, 8, 9, 10 months going on a year. And now we're starting to break back out. That's going to be a big issue. Now, we haven't quite started to eclipse the rates that we saw back in the fourth quarter of 2022, but certainly that's where everybody's eyes are right now and are going to be watching that pretty closely. So let's keep a pulse on this. This is certainly impacting a lot of those equity market valuations as yields break out. Now, we're going to talk quickly here and end it a little bit early. Because I am traveling and I don't know how this hardware is going to hold up, and internet connection, frankly. But S&P 500, let's take a quick look here at this chart at least. This is the roadmap we've been using here. So we've been, keeping an eye on this rally with these very kind of simplistic horizontal levels that have been drawn on our charts. If you're following the SMW videos, you know this chart. This is what it's looked like. I don't add a whole lot to this. Try and keep things pretty simple. And just lo and behold here, when we zoom in and we take a look at where this market's failing, it is textbook perfect at this, let's see, I gotta zoom out here, 4,600 area. Now this line, this level, this zone has been on our charts now for quite some time. Talked about it last week, the week before. This has been the relevant target, the headwind that we're going to be paying attention to see how the market reacts at this area. And it certainly was not a prediction that we were going to fail there. It's always an assessment at that spot. And you can see though that the market is clearly giving its signal, and its assessment now is a rejection of this 4,600 zone. We broke below the last 2 weeks lows, so we got a nice kind of bearish little outside week here. And when we zoom out a little bit further here, you can see that we are still in this general uptrend. The slope of this rally that started, let's call it off of the pullback correction in March, this is still basically intact here. So again, I look at this as a pullback in motion here. We're waiting to see now where dip buyers step in, how bad do things get, but this is the time where we want to be creating that shopping list. We want to be looking at stocks that are holding up a little bit better, that are acting with some relative strength, and are just generally speaking not breaking down below key important longer term levels, and are keeping those uptrends intact. That's what I am going to be doing here as this market pulls back. Allows us to get back in for some entries. Remember, everyone wants a pullback when the market is trekking higher. Nobody wants to chase. Everybody's waiting for that pullback. Well, now we're starting to get a pullback. And so now you just got to, ask yourself how you're going to get back into this market. What do you need to see? And again, these are all going into personal decisions of everyone's different time frames and strategies, but that's generally the philosophy here as we have this pullback underway. That is the thinking here. Next order, kind of going underneath the hood and looking at those individual stocks that you've been wanting to pull back. So for now, when I look at the S&P 500, if we go down to a daily chart here, we've got a pullback underway. We failed at 4,600 and we are approximately, let's see, about 2.7% off of these recent highs here. So how bad can it get? Well, a 5, 6, 7% pullback seems like it would be pretty orderly and in the cards given how much the S&P 500 has moved up this year. For me, the big levels that I'm still going to pay attention to come back down here around 4,300. This is sort of the bigger zone here. There's confluence going back earlier in the year or last year as well. But if we got all the way back there, and again, I'm not saying that is where we're going, but it would be about a 6.5% correction from the recent highs made around 4,600. That seems like a good logical spot. Can buyers defend this, keep those intermediate trends intact? That would be something I'd be paying attention to. Again, not a prediction, not saying we're going there, but that would be the big level of interest. For now, we went out on the week here, closing on the lows. We're going to need more proof that buyers are willing to step up early next week. How does the market settle in? Do we start with some, ugly gap down on Monday? Obviously would not set the tone that a near-term bottom is intact, but that's kind of the next set of clues. We've got some gap down here that we could fill around 44.40, 44.45 or so. So that'd be another 40 S&P points below us. Maybe buyers step back in there. And then, of course, you've got just this little mini level here that started the month of July on, where dip buyers kind of stepped in here right around that first week of July. So holiday time, 4,400. We could see if we make our way back down there as well if buyers are just as eager to step back up. So that's kind of what I'll be looking at for big picture S&P 500. If we look at the Nasdaq 100, well, we're kind of sitting right back to this level. If you recall, a few weeks ago, we talked about 370 as a level that of interest where we want to see buyers step up and defend. We're right here again now. We got some big tech earnings out of the way. We had Apple, which certainly helped lead things lower this week. They reported earnings 4.8% down. You can see they clearly broke their uptrend that they were in, gap down to start the day, and then pretty much sank lower, heavier volume. But on the other side, we had an Amazon, which closed near its lows or on its lows for the session, but certainly up 8.5%. Big move up for Amazon. So again, we're getting this picture of just mixed earnings. For every stock that's up 5, 6, 7, 8%, there's another one that's down 5, 6, 7, 8%. So clearly a stock picker's market, and earnings season is certainly favoring some, but not all this time around. So Qs, technically at this 370 zone. Let's see how it handles it. If it slices through, I'd be paying attention to this 356, but under 370 for Qs, you gotta objectively just understand that you're lost some momentum and some of that short-term trend. If we go to the Russell 2000, you can see around this 194 zone. That's what I'd be paying attention to there. You can see it held up pretty well this week. It didn't roll over like the rest of things. It held up. It's pretty much 1% or 2% away from the recent highs here. 2% from the recent highs made late last week on. Actually, no, that was this Monday. So Monday it made a high all the way up at 198, trading at 194 now. Still at the upper end of its range. We talked about the peaks here, the upper end of a multi-year range, and how how important this area is for Russell 2000. It does seem like it's stumbling a little bit, but let's see if it gets that follow through down 4 days in a row going into the weekend. So that is the main story. Again, keep an eye on interest rates. This is TLT, right? We talked about TLT a few weeks ago. Clearly broke down from this range. IEF, right? Clearly starting to break down and test the bottom end of its range. All of these markets, fixed income, had a nice rebound day on Friday, which was nice to see. Really sort of working off extreme oversold conditions more than changing a trend at this point. But I think that's still the big story, is interest rates driving this market. And again, we'll keep those cues on to see how equity markets fare. So that is all for me on this week. Hopefully you did well out there. Leave a comment below. Let me know what you're looking at. And again, I want to thank you for tuning in to our Stock Market Weekly updates every single Friday. So check out the links in the description below for you TC2000 users. We got a lot of cool stuff. A lot of the scans, screens, indicators that you saw in this video is available on our website as well. So check it out there. Have a great weekend. We'll see you all next week.